Well, good evening everybody. Welcome to the second in a series of 2 webinars about variances. A couple of weeks ago we covered material and labour variances. This time we're looking at everybody's favourite, fixed overhead variances. This is one of those topics that most people find extremely challenging at first, but I like to think it's one of those that once you see through all the jargon and get a picture of what's really happening, it's actually quite manageable. You'll be pleased to know that if you've got any questions tonight, my colleague Alan Dawson is riding shotgun on the chat panel, so fire away any questions that arise on the way. Hopefully not too many, and Alan will answer them. So without further ado, we'll launch into the presentation, and we'll switch my face off, I think. Okay, right. Fixed overheads. We should probably start just by clarifying what we mean by fixed overheads. We want to make a product. We're going to need materials, we're going to need labour. Those are the variable costs, the direct costs. But most products need to be made somewhere. We can't really make furniture in the middle of a field. We need a factory. We're not going to get paid by our customers if we don't send out invoices. We're probably going to use machinery which will need maintaining and it will have depreciation. There are lots of costs of being in business that arise really whether we're making anything, doing anything or not. And those costs, sometimes called standing costs, are fixed overheads. Having got that thought lodged in mind, in any business we've got to know what it costs us to make our product. We know that it's going to cost us material and labour, but given that we can't produce our product without incurring all of these fixed costs, we have to have some mechanism of including an amount of overheads in the cost of every product that we make. And this process is called overhead absorption. Every single item that we make is said to absorb some of the annual running cost of the factory, the business, or whatever. Now, so how are we going to go about doing this? Well, if we only made a single product, it would be very easy, because all we would have to do is say, well, at the start of the year, how much we're going to spend, divide that by how many units we're going to make, and that will tell us how much each unit has to absorb. Easy peasy. At the start of the year, we would estimate our expenditure. That's a budgeted expenditure. Likewise, we would have an idea, we would set a budget of how many units to make. So that's it, easy peasy. Let's do an example with some simple figures of this case. So let's say that we anticipate spending £500,000. We expect to make 25,000 units. Each unit is going to absorb 500 divided by 25, which is £20. Let's produce a cost card just so we can tie down some numbers a bit. So if we say, just picking figures out of the air, our variable costs comprise £20 of material, £15 labour. Little refresher, that would give us a marginal cost of £35. And then if we move those up a bit, add on the £20 fixed overhead we've just calculated, we would say our product has a full absorption cost of £55. Make sure that you are totally familiar. Marginal cost, I like to think of that, the easy way to remember it is it's the make one more cost. If I make one more of the item, how much will it cost? Marginal cost. Full absorption cost is the whole year's worth of costs divided by the whole year's worth of production. So we'll pop that data card up in the corner, and let's think about situations that might arise. Now, first possibility, in an ideal world, if the amount that we spend is exactly the same as expected and the output is exactly as planned, then our product has cost us to make exactly what we expected it to make. On the other hand, if we spend more than we expected to spend, if our overhead expense is greater than, in this example, £500,000, assuming we make the same amount of product, then our product has cost us more to make than expected. On the other hand, if we spend less than we planned, then we've saved money in the cost of our product. We're going to look in a few minutes at how we deal with differences in cost, but for now it's just want you to get the idea in mind. The other thing that might change, of course, for a given amount of expenditure, if we produce more than we planned, then each unit has cost a bit less than we expected. On the other hand, if we make less, then it's cost us more than we thought. Right, time for some terminology. If we spend more than we absorb, we call it under absorption. Each item is said to have each item has absorbed. No, forget that. The total amount of overhead absorbed is not as much as we've spent. Let's do an example. Let's say it actually turns out we spend £520,000 during a year. The number of units we make is actually 25,500. So at £20 a unit, that's 510,000. That means we've under absorbed £10,000 worth of overheads. This means, in plain English, our product is costing us more to make than we expected it to. On the other hand, if we spend less than the amount absorbed, we call it over absorption. Different example, let's say we actually spend £505,000. We produce 26,000 units. So that means at £20 a unit we absorb 520,000. We've over absorbed 15,000. Our product is £15,000 cheaper over the year than we expected. We've made, if you like, £15,000 more profit than we thought. How do we deal with this? What we don't do in the short term, I have to stress short term, we don't adjust the cost of the product. If we find over an extended period of time we are constantly absorbing a different amount to what's planned, then we would revise the standard cost. But in the short term, we treat it as a one-off. The cost of the product stays as per the standard that has been set and the standard on which the budget is based. If we have under-absorbed, that means our product is dearer than planned, we charge that as a one-off expense to the statement of profit and loss, profit or loss. If we over-absorb, then we post it as a revenue, as a one-off gain. So, easy examples there using one product. Of course, real life it isn't quite as simple because most businesses make more than one product. So we have to have some sort of a method of allocating a different amount of overhead to different products. Because obviously, if you're making pianos and whistles, a large product like a piano is going to use up a lot more of the organisation's resources than a small product like a whistle. I could have said maybe a table and a chair. So we've got to look at all of the products and work out some means of sharing out the overheads in a fair way. The problem we have is if we simply charge too little overhead to a large product, we will think we're making it cheaper than we really are. If we charge too much overhead to a small product, then we are going to think it's very expensive. We'll probably try to sell it at too high a price and we won't sell any. So we have to have a realistic method of sharing overheads on products. And what we have available to us is, there's one thing that all products have in common. They all take time to produce. So what we therefore do is, we don't just count the number of units we produce, we convert the units of output, the products we make, we convert them into a number of hours, which is a simpler thing to do than it sounds. All we do is, if a unit takes 2 hours to produce and we produce 10 of them, that's 2 times 10, that's 20 hours worth of output. So we can therefore have different products, different amounts of different products. We just roll up the number of hours and the number of each product, and we can total up the whole of the factory's output across several products as a number of hours. And that means we can share those overheads across any number of products. You'll be relieved to know we're just going to stick to the one for tonight, but 1 product, 2 products, 10 products, easy peasy. Now, having said they all take time to produce, there are 2 different types of time that we measure in a factory. We talk in terms of labour hours and we talk about machine hours. Now, if you've got a small business, perhaps with a couple of craftsmen whittling out wooden furniture, the chances are most of the costs of your business are to do with the labour of those productive staff. And in that case, you would count up the total number of man hours that were worked during the period of time and how long each product took in terms of labour hours, and that's what you would use. Alternatively, I imagine most people listening live in a house. However, yes, anybody who lives in a house? I'm just checking who's listening, you see, who's nodded off. Okay. Okay, I think you all live in houses. I would imagine in those houses you have a kitchen. Now, if you look around a kitchen, unless you're extremely posh, I won't name any names here, you've got a kitchen that's made out of furniture that is produced in a massive factory. You know, it's produced by huge machines. No, I can't name them because they're not there anymore. Used to be Hygiene, used to be the big one. The factory that produces kitchen furniture has probably got a couple of million. Very good, Tracy. It's probably got several £1 million worth of machinery and quite a small number of staff who are keeping an eye on running those machines. So in a heavily mechanized organization, we would be more interested in how much machine time a product took rather than the labor of the people who work in it. Now, in the real life, in the real world, in a factory, in an organization, you'd have to make that decision. Are my costs machine based or are they labor based? So if mostly work is done by hand, we use labor hours. If it's done by machines, we use machine hours. In an AAT assessment, it's much easier because the examiner will assume that the data that he's given you, you'll have a different number of machine hours to labor hours, most likely. You simply take whichever has the greatest number of hours and therefore gives the lower rate. You might see an example where it says production is largely machine based. I can't remember seeing one like that for a few years. Almost certainly they'll simply give you a number of hours. So you just choose the biggest number of hours, the lowest rate. But, you know, read, as always with exams, especially at level 4, read the questions carefully. Richard's asked a good question. Alan will get that in a minute. Okay. So let's move on to some more numbers. We talked about our product earlier that we said we were going to make 25,000 of that product. Let's say it takes half an hour to make that product. So instead of showing our budget as 25,000 units, we could say it was 12,500 hours worth of output. We could express our absorption rate as £500,000 divided by those hours. That is to say £40 per hour. It makes no difference to the amount absorbed per product. Quite simply, half an hour at £40, it's still £20 a unit. Makes no difference to that individual product, but if we had more, then it would be essential. So let's think about what happens in reality. We've said in an ideal world, you make a plan, your budget and reality are an exact match. You make what you say you're going to make, you spend what you say you're going to spend. In real life and in AAT exams certainly, it seldom works out that way. Two things can happen that will cause either under or over absorption, and typically there will be a combination of the two. First thing that could be different is the amount we spend. The second thing could be the amount or the volume we produce. I've deliberately used the word volume because I want to lodge the word volume. Quantity, amount, how much, the volume of production. Anybody who's read the book will think that's a word we're going to meet in a minute, and indeed we are. Okay, let's look at the names that we use, a bit more jargon coming up now. Difference due to the amount that we spend is called the expenditure variance. This one is the one that's the easiest to work with, and it's quite straightforward. If we spend more than we expected, I'd call that bad news. Therefore, that's an adverse variance. On the other hand, if we spend less than expected, that's good news. We're happy. A favourable variance. That's a fairly straightforward one. I don't think we need to linger on that point. Where it gets trickier, let's look at the next one. Difference due to the amount, brackets, volume, close brackets, produced, is called the volume variance. The way I taught myself to remember this, I thought if I'm listening to music or similar and I want to change the amount of sound, I've got a volume control. So think of volume, the amount, volume variance. Now, if we produce less than expected, assuming all else is equal, such as the amount we've spent on overheads, well, that's bad news. That's going to give us an adverse variance. We've got less product out for what we've spent. Bad news, adverse. On the other hand, if production's more than expected, that's good news. That's favourable. Now, time for some more numbers. What we're going to do is, if we look again at those two examples from earlier, in both cases we said we expected to spend £500,000. We therefore expected to absorb £500,000. It's logical, because we always expect. The idea is once we know what we expect to spend, we plan our production to match that, and we base our standard cost on the assumption that we will make enough product to absorb what we spend. So those two figures will always be the same. I think I've laboured a bit on a fairly easy point there. Budgeted expenditure and budgeted absorption will both start from the same figure. So let's look at example 1 again, and there's a little bit more data now. There's our budget expenditure. We're going to absorb that into 25,000 units. We actually spend 520,000. We actually produce 25,500 units. And there's an extra bit of data, the need for which will become apparent in a few minutes' time, and that is that we've actually worked 12,800 hours. Now, let's keep the data card there because we will need to refer to that. Okay. Let's start to lay out a template for our workings. First column in our template is the budget, and there we go, £500,000, which is the expenditure, just an amount of money. In terms of the volume absorbed, that is 12,500 hours, because each unit is 25,000 times a half, times £40, which was the absorption rate that we worked at earlier. We actually spent 520,000. So our actual absorption, 510,000, because we made 25,500 units, which equates to 12,750 hours worth of output. Now we can put some variances in. Move that up a bit. Expenditure, £20,000 more than expected. Adverse variance, obviously bad news. The volume variance, on the other hand, we produced more than expected, which is therefore favourable. That's good news. So far, so good. Let's look at the second example. On this occasion, we said we plan to spend £500,000 again. We also plan to produce 25,000. This time we spent £505,000. We produced 26,000 units. We worked 12,400 hours. So once again, we can lay out the template. This time 505. Now we can calculate. We've spent 5,000 more than planned. More bad news. Somebody's going to be in bother for this. Absorption, thankfully, was also favourable this time. With favourable volume variance of 20,000. And if you recall, we said that on that second example, we actually had 15,000 over absorption. The combination of your expenditure variance and volume variance will give you the under or over absorption. So they can both be high, they can both be low. You can get a combination of one up, one down. Let's take this a bit further. Volume variance, having said that the expenditure variance is just one thing, it's what we spend, the volume variance has two separate causes. Two subvariances that we can create, because there are two things that affect how much is produced. This applies to any kind of work done. The first thing, and the obvious one, how many hours we work. If I've got a deadline to reach for Friday of next week and I've got a certain amount to get done, if I take a day off, that's not going to help. I'm less likely to make my deadline. If I work a couple of extra evenings, I've got more chance to get that work done. Secondly, how efficiently we make use of those hours. There's no point me working all the hours God sends if all I do is talk to people and make tea. I have to fit in a little bit of work somewhere. Okay, let's look now at these in a bit more detail. So, how many hours we work? If we work less hours than planned, this reduces our opportunity to produce. And we have to be very careful that this is not paying any attention at all to what we're doing with those hours. Simply, if we work an hour, we've a chance to get an hour's work done. Let's put that another way. Every hour worked, we have the capacity to get an hour's work done. Because this is the one that we're coming up to now, where the language doesn't always help. Hours worked have capacity to get work done. If we work more hours than planned, this gives us more chance to produce. And we're not interested at this stage in what actually comes out the other end of the production line. Simply, if we work more hours, we can get more done. On the other hand, if we work less, then we can't. And here we are, it's the word I just mentioned, the difference between the budgeted hours and the hours actually worked is called the capacity variance. Each hour has the capacity to get some work done. Here's how you remember it. More hours worked is good news, and you notice we're not making any reference with the capacity variance to what's actually been produced. All we're comparing is budgeted hours and actual hours worked. Less hours worked, less chance to produce. So, translating this into our beloved accounting jargon, hours worked greater than budgeted hours is a favourable capacity variance because the opportunity to produce is improved. Hours worked less than budgeted hours is an adverse capacity variance. If people are off sick, we've less chance to get things done. If a machine breaks down and everybody gets sent home, we've less chance to get things done. Let's look at the other variable, the other thing that affects how much we get done. How efficiently we make use of the hours worked. If you work all the hours God sends and spend it all talking and drinking tea, you won't get anything done. That's not efficient. Not everybody believes this. That's a joke, never mind. We measure the volume of output in terms of how many hours worth of production is achieved, remember. So just to reiterate, half an hour to produce a unit, 10,000 units is worth 5,000 hours. The efficiency variance, efficiency in general is the relationship between what goes in and what comes out. In this case, what goes in is the number of hours worked. What comes out is the number of hours worth of production. From that logic, we could say that if we produce more hours than the time it takes, because we've worked faster, well, that's good news. On the other hand, if the hours worth of work that are produced are less than the number of hours it takes to make them, that's bad news. So if hours of output greater than hours worked, good news. Hours of output less than the hours worked, bad news. In translating into jargon, if we get more production out, more hours worth of production than the hours worked, that's a favourable efficiency variance. If, on the other hand, we produce less hours than we work, then that's an adverse efficiency variance. And note, so what we're comparing, number of hours actually worked, nothing to do with the budget now. The budget doesn't affect the efficiency variance other than in the setting of the hourly rate. We're looking at what was actually worked, the number of hours that we've paid for on the payroll with what came out of the production line. Nothing to do with the budget. So let's look back at our two examples, and this time let's work out the subvariances. So once again, we'll call up data for example 1, and if we can pop that into the corner, what we're going to need to do now is expand our template. Once again, the budget for what we expect to spend is the same as the budget for what we expect to absorb. Now let's add a couple more rows on, one for capacity, one for efficiency. And remember, these are not additional variances. These are the two things that explain the volume variance. Okay, so let's put some more numbers in. The budgeted figure for capacity, having said we expect to spend 500,000 and therefore produce enough product to absorb 500,000, we expect to work enough hours to absorb 500,000. It's the same budgeted figure as the first two. And in fact, in this template, you'll see that very few figures will do all the work for you. So now let's put in some actuals. Notice we haven't put the standard in for efficiency. By standard, I don't mean what was achieved. What I mean is the standard in the general sense, the thing that we measure the efficiency against. We don't know it yet because we don't know what hours were worked. So we don't have a budget for efficiency. We haven't got a thing to measure it against. So let's put in what's really happened. Expenditure as before, 2520. Volume, we've already looked at those. We worked 12,800 hours. At an absorption rate of £40, that should enable us to produce £512,000 worth of output. So that figure, with the box around it, is our starting point against which we now are going to measure the efficiency variance. And in fact, we've also got the finishing figure for the efficiency variance, because that looks at the number of hours worked and what we should have done with what we did do, which is the actual figure for the volume variance. That one. So notice that we've only got the same figure for the budget for 3 of them. We've got the same finishing figure for 2 of them. And the halfway house, which describes the step in between the volume variance is 2 steps. One step is the capacity variance. The second step is the efficiency variance. So the joining figure we've already got. We've only got 4 figures here altogether for all of our variances. Let's work out the variances. We've already talked about that one, and we've already talked about that one. Capacity variance. Now, We've worked more hours than expected. Come on then, time for a poll. Who thinks this is good news and who thinks this is bad news? See who's been listening. The key word, remember, is opportunity. Oh, it's swaying. We've had one or two people on the fence. Okay. Well, overwhelming majority think that working more hours gives us more chance to get work done. And it is good news. It's good news. Remember the capacity variance, we take no account of what we have done with those hours. By itself, working more hours means the chances are we can get more done. And so that one is favourable. Well done to the vast majority of people who got that one right. Now, let's look at efficiency. Let's look at efficiency. We've worked enough hours to enable us to produce £512,000 worth of absorption. We actually managed to absorb £510,000 worth of overheads. So, the question now is, well, I think it's pretty obviously bad news, isn't it? I don't think we need to do a poll on that. Yeah, because in an ideal world, you would always produce an hour's worth of work in an hour attended, given that standards do allow for things like tea breaks and the like. Now, there's a diagram that we can draw. It's certainly one that works for me. If we look at how these fit together, I've already mentioned that the overall volume variance is made up of two steps. We can draw a picture. Here's our budget, £500,000. Here, we need the data once again. We want the data 2 for this. We'll pop data 2 back up in the corner. No, it's the wrong one. Example, it must be example 1. Sorry. That's better. That's better. So, we budgeted to spend £500,000. We actually absorbed £510,000 because that was 12,750 times £40 or 25,500 units. That difference between those two, the overall difference, is our volume variance. And the two things that explain this volume variance, the halfway house figure is the actual hours worked, which was 12,800 hours, which times 40. That is number 2, won't it, actually? There we go. Sorry, folks. Right. The first half of that step between the budget and the hours worked is our capacity variance. We've actually worked. No, it is number 1. We've had a bank holiday, you have to forgive me. We worked 300 more hours than expected, which at £40, so we gained £12,000 worth of potential extra absorption by working extra hours. The second half, the difference is our efficiency variance. And in that, we had an adverse variance because we produced less than the hours worked. But we can see how the difference between the budget absorption and the actual absorption is explained by those two steps. Now we need to look at example 2 again. So if we look at example 2, we can do the same again. So this time we're going to measure our efficiency against the actual hours worked, and we worked less hours than planned. So instead of 12,500, we worked 12,400. This time we know that we produced 520,000, which is 13,000 hours, because it's that repeated figure again. So variances. Okay, 4 to go at. I'd like you to tell us which of these are favourable and which of these are adverse. So we've spent 505,000. Okay, the numbers are coming in. So we've spent more than planned, we've produced more than planned, we've worked less hours than planned, but in those hours we've produced more than we would have expected. Right, I think we can publish. And overall, very good. Vast majority of folk spot on there. The two favourable variances are the volume and the efficiency. We've produced more than planned, and we've produced that in less hours than we would expect it to take. And the bad news is that we've spent more than planned. We didn't work as many hours as expected, which did reduce our opportunities. So plainly, the people on the shop floor have had to work very hard and very efficiently to make up for that shortfall. Let's put those in, and there they go. Once again, we can draw the diagram. There's the budget. Our actual absorption, 520,000, is the volume variance. In between is the number of hours worked, and in this case our capacity variance was adverse because for whatever reason, maybe a machine breakdown, maybe a bout of flu swept through the workforce, but we were short of hours. Not as many hours were available for production, but in that time we worked very efficiently. No doubt they'll all be due a generous bonus. One final thought. Looking at the template, one thing I've done before to make these easier to follow is coloured them in. The three budgeted figures that are the same, notice they're all sort of in that pale tan colour. The final output in red is the same, and that stepping stone in between, the halfway house for the volume variance, we've done in blue. Got just one final thought. Always when you've got a variance, you can't say, is it the left, is it the right, right over left, left before right. What you have to say is it good news or bad news? If you spent more than you expected, in my book, that generally goes down as bad news. If, on the other hand, you've produced more than was anticipated, well, that's good news. Use your common sense. You know, you can't, don't get into the trap of if the left's bigger than the right or the right's bigger than the left. Just look at it before you work the numbers out. Good news, bad news. That's a good idea, Sam. Yes. Suggestion here is if you're doing variances, use green for good news and red for bad news. Mind you, those are budgeted figures, not necessarily good or bad or either. And that, everybody, concludes the session. Thank you for listening. And good night. Tracy Hunter says the PC crash, can we email the... Oh, I've said it already. Ooh, Julie West is brilliant. Thanks.